Hey everybody, welcome to this video. My name is Zana Hawleri, and in this video I will break down the BRRRR method. Whether you've heard the BRRRR method or this is your first time being introduced to it, it's a very simple process of how you can own a turnkey, fully rehab property with no money out of pocket. Let's dive in. So the BRRRR method stands for, it's BRRRR. This seems like there's 40 R's in it, but it's very, very simple. The B stands for buy. This is how we buy the property. The R stands for rehab. This is where we rehab the property. The next R is for rent. We rent the property out for a seasoning period in order to do the next step, which is refinance. Once we refinance it, what do? We take our money and we go do it all over again. So the final R is repeat. So essentially, to give you a quick breakdown of how this work is, if you were to buy a property for $100,000, and let's just say you put $40,000 into the rehab, and let's, in this scenario, the property appraised for $200,000. So you're in this property for $140,000, and you're looking to refinance it so you can pull your money out of it. And typically what banks do is they lend 70 to 80% of the ARV, which is the after repair value, which in this scenario is $200,000. So if they were to give you, just on a bad day, say you don't have the best credit in the world, minimum they give you 70%, that's $140,000 that they'll give you as leverage or a mortgage on the property. So now you've invested $140,000, a fully rehab property, and the banks are willing to give you the $140,000 or maybe even more than that sometimes. You can actually walk away with a check in hand at closing. So you're in it for $140,000, the banks give you $150,000 or $160,000, you walk away with $10,000 or $20,000. So you've made money on a property where you're now out of pocket nothing. In our scenario, we bought it for $100,000, we put $40,000 in it, it's worth $200,000. We don't have the best credit, so we refinance at 70% of ARV, which is that $200,000. The banks will give us a loan for $140,000, so we take all of our money out, and then we take that $140,000 and we repeat the process all over again. Now we have a turnkey rental that's renting for, let's say it's renting for $1,400, $1,500, whatever the case might be in this scenario. But now we can duplicate this process. We can go buy another property for $100,000, put another $40,000 in it, and we just keep turning the wheel. And you might be thinking, well, I don't have $140,000 laying around, which is okay, because you can do this with hard money. And the best way to do this is you get a hard money loan, and typically they lend up to 70 to 75% of ARV, which is if that property appraised for $200,000 based on your scope of work, say it did appraise for $200,000. The banks are willing to fund that entire amount for you. Now, typically you do have to come out of pocket between 10 and 20%, and this just depends on your experience and also your credit sometimes. And this is from deal to deal basis. So I highly recommend you consult and interview some of your hard money lenders in your area to see who gives you the better rates, who's easier to work with, and things of that nature. So if you're using a hard money lender, they'll lend you the purchase price, most of the rehab, or vice versa, or a combination of both. And then when you're ready to refinance, you can go to a traditional bank. It could be a Bank of America, a community bank, whoever that might be that you have a relationship with, or, and that goes in your personal name, let me say that first. Or if you're looking to put something in an LLC's name, hard money lenders these days are actually lending in LLC names. But just know that if you were to go to a community bank or a traditional institution, you're going to pay, let's just, for example, if the nation rates right now are 3% for a rental, because it's an investment, that's going to be, typically it's going to be just a little bit higher. With hard money, it's even going to be higher than that. Now, the reason why you might want to consider putting that property in an LLC, it's because your personal name is not attached to it. So they give that loan, you personally guarantee the loan, but it's in the LLC's name. And to piggyback off of that, you are, as an individual, you can only have 10 properties in your personal name that goes on your credit report. So let's say you've had 10 rentals, the 11th one might want to go into an LLC by itself. Yes, you're paying a higher interest rate, but now you're acquiring more properties. That's the BRRRR method in a nutshell. If you guys have any questions or comments, make sure you leave a comment below. I'll be happy to answer any questions or comments you guys have. Thank you for tuning in. Take care.